Welcome back to Talk Tickers. If you are tuning in right now, you are the type of investor who knows that the real alpha isn't sitting right there in the headlines. It's hidden in the footnotes. It's in the tone shifts. It's in that gap between what management says and what the numbers actually show.
That is exactly right. We do the heavy listening so you can do the trading. Because let's be honest, you do not have the time to sit through 45 minutes of corporate hold music and safe harbor statements.
No one does. So today we are jumping into a deep dive on ticker NTR, that is Nutrien. It is Saturday, February 21st, 2026. The earnings call dropped just 2 days ago on the 19th, covering the fourth quarter of 2025.
And this is a big one. I mean, Nutrien isn't just some run-of-the-mill fertilizer company. They are the world's largest provider of crop inputs and services.
Yeah, I always like to think of them as effectively the grocery store for farmers.
Yeah.
If you need to grow food, they sell it. But the conversation we are going to have today, it isn't just about potash and nitrogen. It is about a massive portfolio simplification.
Yeah.
We're talking complex geopolitical gas plays in the Caribbean. And honestly, my personal favorite part of this print,
The robot miners.
the robot miners, exactly.
It really was a fascinating quarter, and I think the best way to set the tone here is to just look at the market reaction first. The stock didn't crater, but it certainly didn't go to the moon either.
Right.
It was very much a show-me quarter. Management is out there claiming an execution victory, saying they're hitting all their strategic targets. But if you actually pull apart the numbers, things were a little messier than that narrative suggests.
Exactly. We are going to parse that gap between the narrative and the gap accounting today. So let's unpack the results snapshot. What are the headline numbers that everyone on the street is looking at?
Let's start with the bottom line. Adjusted EPS came in at 83 cents. Now, the street was looking for 92 cents.
So a miss.
It is a miss. That is roughly a 10% miss. Now, if you look at the GAAP EPS, the unadjusted number, it was actually higher. It sat at $1.18.
But you have to be careful with that. Right?
Very careful. That GAAP number includes some one-time portfolio gains from selling off assets. The street always looks at the adjusted number to see the actual health of the core continuing business, and on that front, they definitely came up light.
Okay, so a miss on earnings. What about the top line?
Revenue came in at $5.34 billion. The consensus was sitting at $5.38 billion. So a slight miss there as well.
Right, so we have a miss on the top and a miss on the bottom. That usually spells disaster for a stock. But there was some actual growth here, wasn't there?
There was, and this is why you have to look past the quarter. Despite the miss against Q4 expectations, if you zoom out and look at the full year of 2025, adjusted EBITDA was actually up 13% year over year. Yeah, they cleared over $6 billion in EBITDA for the year. So the company's growing, they are generating cash. They just didn't grow quite as much in those last 3 months as the analysts had penciled into their spreadsheets.
And how did the market digest this? You mentioned it didn't crater.
It was what I would call muted disappointment. Immediately following the print, pre-market, the stock was down about 0.87%. It traded in a relatively tight range during the day between $69.40 and $72.15. It eventually closed around $71.78.
And volume. Was there panic selling?
No, not at all. About 3.83 million shares moved. So decent liquidity, typical for them, but definitely not a panic sell-off.
It feels like the market is just taking a breather. I mean, the stock has had a pretty great run recently.
It has. It's up about 28% in just the last 3 months. When a stock runs up that much, a lot of perfect execution gets baked into the price. A miss on the top and bottom lines for Q4 just stalls that momentum. It really feels like investors are pausing to see if the 2026 guidance actually holds water before taking the next leg up.
Speaking of that guidance, what are they telling us to expect for 2026?
They are keeping it fairly tight. For retail EBITDA, they are guiding between $1.75 billion and $1.95 billion. For potash volumes, they are looking at 14.1 to 14.8 million tons. And they are keeping the checkbook relatively closed on spending. CapEx is guided at $2.0 billion to $2.1 billion.
So steady as she goes, maintaining capital discipline. Let's get into the deep dive on the segments. I want to start with the potash business because when you read through this print, this seems to be the absolute engine room of the company right now.
Oh, it absolutely is. And the story here is really about volume and what they are branding as their industrial edge.
Break down that volume story for us.
They hit record fertilizer sales volumes in fiscal year 2025. We are talking 27.5 million tons total across all nutrients. But for potash specifically, management is projecting global shipments to hit between 74 and 77 million tons in 2026.
That is a staggering amount of fertilizer moving around the world. What is the bull case here? Why do they think demand is going to be that strong?
Well, this would be the fourth consecutive year of global demand growth. It's a very strong structural trend line. And management was very insistent on the call that inventories are not building up in the channel.
That's a crucial distinction.
Yeah.
Because if you're shipping product, but it's just sitting in a warehouse in South America somewhere, that's not real demand. That's just a glut waiting to happen.
Precisely. It pulls forward future sales and kills pricing. But Nutrien insists that consumption equals shipments right now. They pointed to early contract settlements in China and very tight inventories on the ground in Brazil. That suggests the global channel is effectively empty and desperately needs refilling. If farmers want to grow crops this spring, they have to buy now.
So the demand is there. The channel is clear. But what I found really fascinating, and we teased this earlier, was the cost side of the equation. This is where the robots come in.
This is the real chess move they are making. Their controllable cash cost for potash came in at $58 per ton. Their stated goal was $60, so they beat it. And a huge driver of that efficiency is automation.
And we were just talking about, an automated conveyor belt sorting rocks here.
No, we're talking about teleremote or fully autonomous mining deep underground. They revealed that 49% of their potash ore tons were mined using automation.
Nearly half. Half of their production is untouched by human hands at the point of extraction.
Correct. And this isn't just cool tech for the sake of a press release. It removes human operators from highly dangerous underground environments, which is a massive safety plus and reduces liability. But financially, it fights inflation.
Because robots don't ask for a cost of living raise.
Exactly. Labor costs go up. Healthcare costs go up. But if you have robots doing the digging, you lock in a much more predictable cost curve. And it scales beautifully.
Right, because if they expand volume to meet that 77 million ton global demand, they are doing it over a fixed cost base.
Which drives margins significantly higher. Every extra ton they dig out with an autonomous machine is more profitable than the last one. It's immense operating leverage.
And they seem to have the pricing power to protect those margins too. I saw that benchmark prices are up about 20% compared to 12 months ago.
They are. And their winter fill programs in the U.S. were completely fully subscribed.
Meaning farmers and retailers were locking in their orders and prices early.
Yeah, that signals absolute confidence in the pricing floor. Buyers don't lock in early if they think prices are going to drop next month.
So potash looks incredibly strong. Automated, highly profitable, growing volume. Let's pivot to nitrogen, because this feels like a completely different story. This segment is less about growth and much more about what they are calling portfolio pruning.
Pruning is a polite word for it. It is a cleanup operation. Nutrien is effectively getting out of the high-cost and uncertain gas game entirely.
This involves the Trinidad and New Madrid facilities, right?
It does. They announced they are actively assessing options for their Trinidad nitrogen operations. And they actually ceased production completely at the New Madrid upgrade facility at the end of 2025.
Why shut these down? Especially if fertilizer demand is growing globally.
The logic is brutal but simple. These facilities accounted for about 15% of their total nitrogen volume, but they contributed minimal free cash flow.
So they were doing a lot of heavy lifting for very little actual pay, just churning revenue with no profit.
Exactly. And the why behind this is fascinating. It's pure geopolitics.
This is the Venezuela connection you were tracking.
Yes. The Trinidad gas situation is incredibly messy. To run that facility efficiently, it relies heavily on a pipeline supplying natural gas from Venezuela, specifically the Dragon gas field. And on the call, they were very skeptical about Venezuelan gas flowing reliably anytime soon due to the geopolitical uncertainty and sanctions in the region.
You just can't run a reliable, multi-billion-dollar industrial operation if your core feedstock depends on the political whims of a regime like that.
You really can't. The risk premium is too high. So the result is that Nutrien's nitrogen production is now tied entirely to North American natural gas. They are keyed into AECO and Henry Hub benchmarks.
Which creates a massive structural advantage.
A phenomenal one. North American natural gas is significantly cheaper and more reliably sourced than the liquefied natural gas that their European competitors have to import and rely on. By cutting out the Caribbean volatility, they are essentially betting the house on the North American energy cost advantage.
They are shrinking the nitrogen footprint to make the overall segment much more profitable.
Precisely. Quality of earnings over quantity of earnings. And it's worth noting that ammonia markets globally are quite tight right now due to project delays and competitor outages. So they are selling this North American produced nitrogen into a very healthy pricing environment.
Okay, let's move to segment 3, which is retail. Now, this is usually the steady compounding, boring part of the business, but they missed the quarter here. What exactly happened?
It was a combination of really bad luck and some intentional strategic shifts. The biggest driver for the miss was weather. There was a historic washout in the U.S. South, specifically the Delta region. It completely killed the fall application window.
If the fields are literally flooded, you can't drive a heavy tractor over them to spread fertilizer. It just doesn't work.
Simple physics, you get stuck in the mud. And because they couldn't get the product onto the ground, they ended up with a massive inventory hangover. Working capital built up by about $300 million.
That is $300 million of cash tied up in physical bags and tanks of fertilizer just sitting in a warehouse doing nothing.
Right. And then there were the seed sales. They were down significantly in the quarter. Partly that was the weather we just talked about, but partly it was a deliberate strategic choice to stop selling low-margin seeds in Brazil.
Brazil seems to be a recurring headache for them every time we look at this company.
It is the Brazilian headwind. Now, they did make progress. They moved from taking a loss down there in 2024 to being close to break even in 2025.
But break even isn't exactly a victory parade when you have that much capital deployed in a region.
No, it's not. It is still a drag on their overall return on capital. Management stated explicitly that they are actively reviewing alternatives for the Brazil business.
We know what that means.
Yeah. In corporate speak, that is direct code for fix it immediately or we are going to sell it. They are losing patience with the underperformance there.
But there was a bright spot in retail, right? The proprietary products.
This is their moat. This is the defense mechanism. Gross margins for their proprietary products grew 5% in 2025, despite all the weather chaos and the Brazil issues. And they are launching 26 new products in 2026 alone.
Why is this proprietary angle so important for their long-term survival?
It's their defense against total commoditization. They openly admitted on the call that cheap Chinese generic crop inputs are entering the global market. If Nutrien is just selling generic nitrogen or generic seeds, they have to compete on a race to the bottom for price.
Right, because nitrogen is nitrogen.
Exactly. But if they are selling a proprietary chemical blend that increases a farmer's yield in a specific, measurable way, they suddenly have incredible pricing power. It transforms them from a simple commodity seller into an agricultural technology provider. The farmer isn't buying fertilizer, they're buying guaranteed yield.
Okay, let's talk about the fourth segment, phosphate. Based on what they were saying, it sounds like this entire business unit might be on the chopping block.
It's more than just a sound at this point. It's a blaring signal. They explicitly stated they are reviewing strategic alternatives for the phosphate business.
And as we just discussed with Brazil, strategic alternatives almost always means putting out the for sale sign.
Usually, yes. They expect a final decision or a solidified path forward sometime in 2026. The main assets involved here are the Aurora and White Springs mines.
Is there actual interest from buyers out there?
The whisper on the street is that they have had significant inbounds of interest already. They are supposedly preparing data rooms for a potential sale as we speak.
What is the implication for the stock if they actually sell phosphate?
If they sell it, that is a massive one-time injection of cash. They can use that to either buy back a mountain of stock or pay down debt. But strategically, it furthers this whole narrative of simplification. They want to be a potash and nitrogen manufacturing powerhouse paired with a high-margin retail arm and just shed everything else that distracts from that.
So that brings us perfectly to the investor context. What does all of this mean for you, the person actually holding the stock? What is their capital allocation strategy while we wait for these structural changes?
The message from management is very clear. We are paying you to wait. The board just authorized a new 5% share repurchase program, and they haven't just been talking about it. They have been actively buying back about $50 million worth of stock per month consistently.
That puts a really nice floor under the share price.
It does. It absorbs any weak hand selling. And on top of that, they raised the dividend to 55 cents per quarter. This is the 8th consecutive year of dividend increases.
And the balance sheet health.
Very clean. They paid down $600 million in short-term debt recently, so they are leaner, they have less interest expense, and they are highly focused.
Let's pull back and look at the macro backdrop, because you can have the absolute best company in the world, the best robots, the cleanest balance sheet. But if the macro environment is swimming against you, you're going to struggle. What are we seeing with the actual farmers, the customers?
Farmer economics are definitely under pressure right now. Grain prices are not sitting at the record highs we saw a few years ago, but the input costs, equipment, labor, land remain very sticky. This creates a severe margin squeeze for the farmer.
Which usually leads to a change in buying behavior.
Yes, it leads to just-in-time buying. Farmers wait until the very last possible second to buy their fertilizer, hoping that the prices will drop before they have to plant. This makes quarterly earnings for companies like Nutrien very volatile and lumpy, which is exactly why they missed Q4 expectations. The buying just got pushed.
But there is a counterforce to that economic pressure, isn't there? The soil itself.
The soil chemistry argument. This is the absolute core of the bullish thesis. You can only skip fertilizer for so long before the ground stops producing. 2025 had record crop yields in North America.
And a record crop means the plant sucked a record amount of nutrients out of the dirt.
Exactly. The soil is severely depleted right now. 2026 must be a massive replenishment year, or those farmers' yields will crash. You can delay buying, you can hope for better prices, but you cannot cheat biology. The nutrients have to go back into the ground.
So where does that leave us on valuation and sentiment? Because it feels like a tug of war.
It's a bit of a disconnect right now. The stock is up 32% year over year. The market has, to some extent, already priced in this 2026 recovery. But the major analysts, Bank of America, Morgan Stanley, RBC, they all raised their price targets into the low to mid 70s range after this print.
Even with the Q4 miss?
Even with the miss. Because they are looking past the messy weather quarter and looking at the structural setup for 2026. The depleted soil, the robot margins, the North American gas advantage. But the Q4 miss does put a temporary ceiling on the stock. Institutional investors need to see the spring season actually happen before they bid it up further.
So it's a show me spring.
It is very much a show me spring. If the bags move out of the warehouses, the stock moves up.
All right, we've covered the numbers, the simplification strategy, and the macro environment. Now it is time for the segment that our compliance officers love to hate.
Please read the disclaimer loud and clear for them.
This is the part of the deep dive where we throw caution to the wind. This is not financial advice. We are not your financial advisors. This is for entertainment purposes only. Do not trade based on what you are about to hear. We are just two people with microphones and a tall stack of earnings transcripts.
Now that we are safe from the regulators, what outrageous idea do you have for us today?
I call this trade the robot farmer spread.
I am intrigued already. Walk me through it.
Here is the setup. Nutrien has successfully automated nearly half its potash mining. Their cost is $58 per ton, which is incredible, and they're operating in North America, locked into cheap, secure natural gas.
Right. High-tech, low geopolitical risk.
Now look at their competitors globally. You have mines in Russia and Belarus dealing with crippling sanctions and absolute logistics hell just trying to get ships out of port. You have competitors in places like Brazil dealing with currency chaos and massive labor inflation.
So it's a divergence trade. You're playing the gap between the two environments.
Exactly. The trade is this. Long Nutrien. You are buying the automation and the North American energy advantage.
And what's the short side to hedge it?
You short a basket of labor-heavy emerging market agricultural miners. Or, if you want to get really specific and play the weather angle, you short a pure-play seed company that has heavy revenue exposure to the U.S. Delta region.
Betting that the flood damage to the soil down there is a multi-year drag on their sales.
Precisely. Because with this pair trade, you are hedging out the underlying commodity price risk. You don't really care if global fertilizer prices go up 10% or drop 10%. You're betting purely on operational efficiency. You're betting that Nutrien's robots mine cheaper than people do, and that North American natural gas stays structurally cheaper than LNG delivered anywhere else in the world.
I actually really like that. It's a geopolitical arbitrage paired with an automation long. It isolates the exact variables where Nutrien is winning. It's sophisticated.
It's the kind of trade that gets you a massive bonus or gets you fired, depending entirely on the weather in April.
Well, that's the game we play.
So let's wrap this up and summarize the deep dive. Nutrien missed the Q4 numbers, but the core thesis seems completely intact. They are actively slimming down. They're cutting out the dead weight in Trinidad and New Madrid. They are putting robots in the mines to crush costs, and they are taking all that cash and buying back their own stock.
The absolute tell for the next quarter will be the spring application season volumes. Watch those shipment numbers like a hawk. If the weather holds and it's a dry spring, that $300 million inventory pileup clears instantly, and their free cash flow is going to explode. But if it rains through April,
Then the 2026 guidance is toast.
exactly, it all hinges on the skies clearing.
I think the most interesting takeaway for me, wrapping all this together, is that they are treating a traditional heavy industry fertilizer company exactly like a modern software company.
How so?
Think about it. They are focusing relentlessly on recurring revenue by pushing these proprietary products where the farmer relies on their specific chemical blend every year. And they are doing bug fixes on their balance sheet via these divestitures, just deleting the code that doesn't generate cash flow.
Yeah.
But it leaves you with a really provocative final thought.
Lay it on me.
We talked about them owning the proprietary seed blends and the exact chemical inputs. If they perfect that and they control the robotic extraction, they aren't just a supplier anymore. They own the entire operating system of global agriculture. If you want to pull a yield out of the ground in 2030, you might essentially be paying a software licensing fee to Nutrien just to unlock your own soil's potential. Think about what that kind of monopoly does to global food security.
It completely centralizes the biological leverage. That is a wild thought to end on.
Thanks for joining us on this deep dive. Don't trade on the headlines, trade on the details. We will see you at the next earnings sprint.